My name's Chris Gosselin from Australian Fund Monitors. Today I'm talking to Richard Brennan from East Coast Capital Management, managers the ECCM Trend Following Futures Fund. Welcome, Richard.
Welcome, Chris.
Nice to see you. You recently released the East Coast Capital Quarterly State of Trend Report, which showed you managed a return of 6.2% in September and 24% over the past 12 months. Yet quarter 3 2024 was a challenging quarter for trend following systems. From your perspective, what were some of the key market dynamics that led to that?
Look, Chris, many factors played a hand in shaping the market movements in that third quarter. Probably the most important one was that major central bank cuts globally were probably the most influential in the performance of the quarter. Sort of while equity and bond markets all benefited from these rate cuts, certain trend following strategies faced difficulties, with increased volatility and what is referred to in our profession as whipsaws.
So despite those challenges, you managed to deliver strong positive performance. What contributed to that outperformance?
Look, we're a very highly diversified program, especially in commodity markets, with about a 40% allocation to this asset class in our investment universe. And this is a sort of higher allocation than most other trend following managers. So there were a number of idiosyncratic trends in the commodities complex in the third quarter, such as cocoa, rubber, oats. And ECCM was able to capitalise on this with our systematic approach, able to adapt quickly, capturing these price trends across these assets, while at the same time reducing our exposure to other markets that were experiencing unfavourable market conditions. Positive divergence against our peers when compared to, say, the SG Trend Index has really solidified over recent times, and we also have this proprietary approach in our models that we believe gives us this distinct edge over time.
Richard, this quarter you included a chart of the month in your State of Trend report on the rubber market, which was up about 25% during the third quarter. I doubt there are many or too many investors who would have exposure to that particular commodity or market. Can you elaborate more on what drives the rubber market and how it's performed?
Yeah, so rubber traded up approximately 25% over quarter 3, continuing an uptrend that has been in existence since early 2023. So, these are examples I'm discussing, of course, for illustration only and not specific recommendations, but the bullish rubber trend, as we see it, has been influenced by strong demand for rubber production in the use of things such as tyres, belts, hoses, seals, and also in supply shortages from extreme weather events in major Southeast Asian source countries such as Thailand and China, which have reduced their latex output. What we love about our diversified universe that we trade in our program is that we can provide access to these relatively exotic instruments, such as rubber, which we agree most investors will not typically have in their portfolios, but we're able to capitalise on these unique trends that frequently are not found in more popular asset markets.
Richard, can you take us through the statistics for quarter 3 on how ECCM performed compared to traditional benchmarks such as ASX 200 return or an Australian 60/40 portfolio?
Yes, Chris. So we benchmark our performance against our peers using the SG Trend Index produced by Societe Generale, which covers global trend following managers. And while past performance is not indicative of future results, our program since inception has significantly outperformed the SG Trend Index. For the third quarter, ECCM posted a return of 4.9% compared to SG Trend's minus 5.9%. And in the almost 5-year period since our program's inception, we've delivered 107% returns compared to the SG Trend Index's 44.7%. While we underperformed in the third quarter against some of the traditional investment benchmarks, such as the ASX 200 and the 60/40 portfolio, the ASX 200 for the third quarter was up 7.8%, and the Australian 60/40 portfolio was up 6%. Over the past 12 months, we've also seen positive divergence against these traditional investment benchmarks, where ECCM's program has returned 24% for the 12 months, compared with the ASX 200 at 20.4% and the 60/40 portfolio at 15.1%. So to reframe this performance in terms of our annualized total return since inception, Chris, we are currently sitting at about 17% compound annual growth rate, compared with the ASX 200 at 8% and the 60/40 portfolio at 5%.
So that's pretty strong performance, Richard, but I assume there are still risks and potential drawdowns involved. Can you elaborate on the risk-return profile of the fund and how that compares with traditional portfolios?
Yes, so our program has maintained a relatively low maximum drawdown of 6.2% since inception in January 2020. Compared to, for example, 26.8% for a 100% investment in the ASX 200. Risk management is core to our trend following process, and we have clear stop loss levels for all our trades, which we implement systematically. Naturally, we do have the potential that we can deliver increased drawdowns over the past, but certainly over the 5 years since inception, we've taken comfort in our systematic approach to managing losses and our strong risk management focus. But aside from ECCM's performance in isolation, Chris, it also acts as a great diversifier for the traditional investment portfolio of stocks and bonds, for example. So a material allocation of trend following into a traditional portfolio of stocks and bonds has been shown to enhance risk-adjusted metrics and expand the efficient frontier. This is due to the low correlation between trend following strategies and these traditional asset classes. So in combination, it produces a smoother ride for investors and doesn't sacrifice what we call the lifting power of the overall portfolio.
Richard, correlation's an interesting topic. How does your fund correlate with major indices such as, say, again, the ASX 200 and a classic Australian 60/40 portfolio?
So the ECCM Systematic Trend program exhibits low correlation with both the ASX 200 and the Australian 60/40 portfolio, with correlation coefficients of 0.29 and 0.23 respectively. So as a general observation, we'd say this low correlation underscores the diversification benefits trend following strategies have as an attractive alternative asset class, particularly in more volatile markets. We think that academic research also bolsters up this opinion in that a material allocation to trends significantly improves, because of its low correlation, that's why it's one of the big diversifiers to a traditional portfolio.
Richard, given those insights, do you see trend following strategies continuing to play a role for investors looking ahead?
Look, I suppose we've got to be careful here. Investors should always approach market strategies with an underlying understanding of the inherent risks and historical performance, variability, and their own financial goals. We make the general observation, however, that despite market volatility and periodic setbacks, trend following strategies have demonstrated their ability to adapt and provide uncorrelated risk-adjusted returns. So as global markets evolve, we believe that systematic trend following will remain a vital component of well-diversified portfolios, particularly when paired with additional traditional asset classes.
Richard, many thanks for your time.